Right, guys. Hi. This is a small chapter on foreign currency. And this foreign currency chapter really is to do with transactions that are happening um, in the foreign transactions that are happening in the statement of financial position. Now, the core here is that many businesses will buy their raw materials and goods they intend to sell in their own home country, right, abroad. This is very normal. And of course, when they buy these goods, they have to, if you like, change their own currency into foreign currency to be able to pay, if you like, the third party, the supplier, because obviously their supplier wants currency in their own currency. They don't want currency in your own presentation or functional currency. So, for example, if you're in South Africa and you trade in the rand, of course, because that's what you do, and you're buying goods from the US, if you like, US suppliers, people who are supplying you, want their money in dollars. So you have to convert rand to dollars if you like to pay them. Now, of course, the problem for you, of course, is that if you buy goods on credit, right, and you if you like, say, for example, you owed them $1 million at the time you actually made the transaction, and you needed, I don't know, 2 million rand to get $1 million, and the currency movements and the currency exchange rates, which you have no control over, change. You still have to pay them $1 million when you pay them. It just means that you might have to bring out more rand if the currency exchange moves against you, or if you like the reverse, issue less rand to meet that $1 million bill. And that's what this chapter is really looking at. So right, so this is IS 21, and it really provides some structure, if you like, as to how you deal with these foreign currency activities. And it talks about only individual transactions being examinable at F7. So we have a couple of rates that we work with. So historical rate is really the rate, the spot rate, the rate that happens at the day, on the day. So, I'll explain why it's also called the historical rate. I mean, it's the spot rate, of course. It's what happens on the day. That's what that transaction exchange is for, and we're done. But what this really means is that, for example, if you're buying any non-current assets on the day, when we talk about here the closing rate, this is the rate at the reporting date. So, for example, at the year end. Well, this is the reason we now have this idea of historical rate is that there are certain transactions we do not change or we do not convert at the year end. And typically, our non-current assets sit in that category where we leave them as they are, as at the historical rate at which we bought them. So you might have bought a machine, if you like, from a foreign supplier, and you record that machine, of course, at the spot rate stroke historical rate when it was bought. Um, but of course, we do have certain monetary assets that we change or convert and check, if you like, at the closing rate every single year. So typically, our trade payables, our trade receivables, we will, if you like, test these assets again at the year end to see whether or not there's been an exchange rate or loss, gain or loss in our favor or against us at the year end. And of course, the average rate deals with how do I deal with transactions that are happening throughout the whole year. So in my income statement, this is where this really applies. In my income statement, I am buying and selling goods throughout the whole year from a range of suppliers. Um, Let me just say with the same one supplier, and the rate is changing from, say, I don't know, a pound to $2.5, a pound to $2.4, a pound to, and I'm having this. So of course, in reality, I'm probably recording the transactions at the spot rate, but for us who are just looking at an income statement for the whole year, we can't find all these many transactions and convert all of them. Will be there all day. So we just assume an average, and that could have been 2.6 or something along those lines. And that's what we use for income transactions and expense transactions over the year. So this is more income and expenses, and this, of course, is to do with assets and liabilities, the closing rate, the movement. So I only say it again, monetary items that can easily be converted into cash. So these are what we call monetary items: receivables, payables, and loans. And then also we have, of course, non-monetary items, if you like, inventory and property, plant, and equipment. And we leave those at the historical rate. Now let's just very quickly talk about what we mean by currencies. So functional currency is really the currency of your own trade. So for example, if you're in the US and you trade in the US and you sell, your customers are mainly in the US, well, that's what you function in. You may buy goods, for example, from Kenya or from the Philippines, but this is just a country you buy goods from. It's not really your functional currency. On the other hand, though, if you, for example, were based I mean, the US is a big country, so I won't use them here. I'll use, say, for example, Indonesia, and you actually, most of your sales were outside the country. Imagine most of them went to China. And imagine you bought all your raw materials, I'm just saying, from China as well. We would argue actually that really and truly, yes, you're based in Indonesia, but your functional currency, the currency in which you are buying your goods and selling your goods, if you like, is the Chinese yuan. That's another way of looking at it. Another interesting way of looking at it is to argue that if you are funded, so if I can't kind of quite work out what your functional currency is based on who you're trading most of the time with and who you're buying your goods most of the time with in terms of the greatest percentage, then I'll look at your funding and I'll sort of say, well, who's funding you? And if, for example, let's think about this Indonesian situation. Imagine they were supplying Chinese, um, um, Zimbabwe, um, Mexico, and I just couldn't, and this is all like say 10%, 10%. So we're doing 10 different countries. And their funding was all American, so all in dollars. I could argue that their functional currency was in dollars because ultimately they have to pay this loan back. So they have to think about how do they convert all these currencies back into income to then pay in dollars. So there we are. So that's what's really happening with functional currency. And so that's the big one. And then presentation currency is really the currency in which financial statements are presented. So really what we're arguing here is how do you prepare your accounts? I mean, are you preparing them in Indonesia? That's great. You would use the Indonesian, I'm assuming the Indonesian dollar or rand, I'm not sure, or lira, whatever it is. But the point is that the presentation currency is really much the currency in which your financial statements are presented. And then the reason why this is important is because if you're consolidating, you would have to convert if you are a subsidiary, you would have to, and your functional currency was, for example, in the South African rand, but you're a subsidiary company of a US company parent, you would have to then convert, if you like, to the presentation currency of your parent. That's where we are. So that's kind of those are the main points. So key point here, of course, in terms of mechanics of translation, at the date of the translation, you use the historic spot rate at the transaction date, right? So that's the point. I could use, if I know that spot rate, but of course I could also use the average rate if I don't see a lot of fluctuation. So this is really the point. It's giving you sort of options to go with. And of course, the day you settle, you also use the rate at the date you settle, right? So you use that date if you like. And then, of course, you might notice that there to be a difference, right? And we'll see that in a question soon. Like I said here, the exchange rates might have moved in your favor. So the date you settle, you might end up spending more rand or spending more dollar. Sorry, spending more rand or spending more whatever it is to convert to the dollar. And therefore, you have a change. And this difference, this exchange difference, gain or loss, goes straight to the income statement, straight to the profit or loss, straight away to the profit or loss. So let's begin by just doing a TYU. Oh, I was going to bring that in. Let me just, a second. Let me just do that now. Just going to bring in the first TYU. Let me just do it while we're here. Stop. TYU1, and let's do this first TYU. Okay, great. So let me just get my calculator. And what we have here, yes, here we are. So we have here, it says on the 1st of April, here that Collins, a company that uses the dollar, so I will just assume they're in the US, uses the dollar as its functional currency, buys goods from an overseas supplier who uses kromets as its functional currency. So the goods are priced at 54,000 kromets. And let's look at what does that mean. So that means that on the day that what you did was you bought some goods, so you would of course, because I mean you're a dollar company, so yes, you bought them in kromets, so you would go 54,000 divided by 1.8, right? You bought them on the 1st of April, 54,000 divided by 1.8. So you're going to recognize, of course, this purchase of 30,000 and credit 30,000 to your trade payables, right? This is just the exchange rate. You know that $30,000, that's your currency, is the equivalent of 54,000 crummets. Now you have to pay 54,000 crummets. That's the point, right? That's what these people owe you. I mean, that's what you owe these guys in crummet land. And on the day, it says the goods are priced here, and then payment is made 2 months later. So 31st of March, it's time to pay them. You need to fork out 54,000 crummets, and the exchange rate is 1.74. Sorry, 1.75. And you realize that at that exchange rate of 1.75, you need 30,857 crummets. But you're currently recognizing only 30 grand. So really what you should do ultimately is really recognize an expense, first of all. This is a loss, if you like, loss on exchange, and credit this with 857, if you like, to trade payables. And then what you now do is you can pay, right? Because now your double entry is fine. Now you can then debit the trade payables with 30,857 and credit bank, because that's what you have to pay. You have to pay 30,857. You owe them crummets. That's what they want, crummets. Cool, great stuff. So that takes us to the end of the first video, and we will carry on in the second video.